Now to Evan Lucas from Investment Employment Data. Evan, the big figures this week, of course, employment data are out, and for the first time we saw a big shrink in the number of jobs in the economy, split basically between full and part-time. How much of a concern is this?
Yeah, it is, Tom, and you need to look at it from several other angles. You've already pointed out the decline across both full and part-time. You need to look at it as being also the worst employment figures in October for 3 years. If you look at employment growth now on a yearly basis, it's now fallen to 2%, which is also the worst reading we've seen in that figure for 30 months. So it's moving in the wrong direction. It goes hand in hand with what we saw on Wednesday with the wage price data, which showed the third quarter declining to 2.2% on a year-on-year basis, which is, again, highlighting that the softness that everybody was expecting in the middle of the year is now becoming actual. Employment had been almost the last bastion of bright spots in terms of what the government and also the RBA had been pointing to, and that now looks like it's going the wrong way. Now, it's probably not enough to see the RBA cut in December, but what yesterday also really highlighted, and the things that really need to be pointed out quite heavily, is the slack in the market. And when we talk about that, that's also not necessarily explained overly that well. Underemployment, that's those that are working but want to work more, ticked up to 8.5% to go with that 3.5% on unemployment, which means underutilisation is now at 13.8%, which is back at the levels that we saw in mid-2016. Until that declines, wages won't move.
Yeah, which seems, well, even further away now. You've mentioned the situation and the trends. We've got that despite RBA cuts. We've got that despite as well, of course, the income tax cut, which has to be washing through the economy right now. I mean, on the RBA cuts, does that mean, what's really the point of going ahead with another? We know it's already firing up the housing market, probably too much. So is it time to put that weapon back in the locker?
Possibly. I think the argument will always be there'll probably be one more. They would go to 0.5%. I don't think the data for October alone is enough to see them going in the first week of December, but it is, if we get November and December showing signs like October, that when they come back from their summer holidays in February, that it's pretty likely they'll cut another 25 basis points. And you're right to argue, what exactly is it doing? Is it actually seeing the stimulatory effect? Their argument at the moment, if you listen to their statement, is that next week we do get their minutes from this month, so the one that happened on Melbourne Cup Day, and it will show very clearly that they are debating this very, very strongly. It's probably also why, and getting back to your question, Tom, around is putting that in the queue in the rack and looking for something else there. We've seen this week that the governor himself, in Philip Lowe, is actually going to do a speech on the 26th of November around unconventional monetary policy. There is no other way to argue this than it's obviously laying the groundwork for what 2020 will be. They are clearly very, very worried that the stodginess in the economy is going to actually start really ramping up next year, and therefore other weapons, as you alluded to, need to be sort of considered and possibly used.
Yeah, and yet the government's sort of arguing subtly against QE and saying don't expect anything in MyEFO. It's acronym soup. Evan Lucas, thanks for your time.
Thanks, Tom.